The Nifty is barely 100 points or 150 points away from making an all-time high. Is it going to do it? Everybody is asking that question. The answer is very simple. Yes. And the reason is not just the trade deal. I mean, that's just the backdrop in which everything is happening. And with last week's gas deal, it's almost certain that the trade deal is coming. What is uncertain is the timing of it all. Is it going to be today? Is it going to be next week? Is it going to be next month? Why are we still waiting for this to play out? Can be a big question mark that we can put in front of us. Maybe there are some items to the trade deal that they want to announce before the deal itself so that they can get the difficult things out of the way and not end up in a controversy. The gas deal is probably one of them. So why announce it outside the trade deal? So that you can get the deal through and not have any controversy around why the government has given away something or not given away something. After all, you heard already a lot of debate around that our own government saying that we are not going to be dictated by somebody else. Now surely that's how it should be and that's what we want to do. But when you're having a negotiation, there are some things that you're going to give and there are some things that you're going to get. And therefore, it cannot be an even plate. But what you have to manage is expectations and the feelings of the mass at large. So that's what I think the market is doing as far as the trade deal is concerned. And because it's almost certain, the market is slowly moving up, pricing it in and waiting for the actual announcement. Now, when the actual announcement itself comes, my sense is there'll be a minimum 3 to 4% move in the market, because that is what ended up happening even in Japan when their trade deal was cleared several months ago. And after that, that market hasn't really stopped. Ours has become the worst performing Asian market because of us being suppressed by the trade deal. But that's not all. It was also because our earnings growth had slowed down most significantly since COVID. Right? We've seen double-digit earnings growth. We've seen in Nifty 50 earnings growth going to even 25-30%. And mid caps, small caps going 40-50%. Then that the numbers came down. The Nifty earnings growth even dropped to single digits over the last 2 quarters. This quarter, we finally seen some kind of a bounce back to early double digits for the Nifty 50 earnings. But the mid cap earnings have still been growing, at double digits and, maybe lower double digits, and now they're moving back to higher double digits. So that's a good sign that the broad market remains very, very strong. And which is why if you plot a ratio chart of the Nifty mid cap to the Nifty, you see it outperforming since the first quarter of 2025. So despite all the talk last year that mid caps are overvalued, they're not going to do well, broadly speaking, the mid cap index is still outperforming the Nifty. Yes, it is true that there are certain stocks where growth slowed down or where the growth was non-existent and those stocks got beaten up. But that's again not a completely true story. A lot of research that I've done, and now we are starting to publish our research even on Indiacharts, on the under Indiacharts research services, because we've become SEBI registered research analysts. What we are really sharing is when you look at prices and you see a wave 2 correction, we are actually able to see that some of the corrections have happened even though companies continue to grow earnings. So what ends up happening is the valuations which were looking high, sometimes in triple digits or high double digits, have all fallen to less than 50 and less than 25 without growth really slowing down to that degree. The earnings growth is still at more than 50% and even 80% for some of the companies. And so that means the companies are now suddenly undervalued. Now, if you're not watching very, very closely, you don't know which those stocks are. We've published some of them and we'll continue to publish more of such ideas in the research services as it goes on. So if you're interested, do take a look at Indiacharts Insiders Club, which is getting revamped and has been, started to publish our research reports. So go and look at them. Now, as we further go into this, so the main point is, where are we in this bull market? Right? A lot of people have tried to call the end and say that, it is not going to go on. We've only waited for the correction to end last year. In fact, in December, I'd already mentioned that the corrective phase goes on to March, and probably after March, things pick up. Unfortunately, we had the trade announcements, which made us sentimentally very, very negative. And then you had all the border dispute and many other things, Iran, Israel. But all of that is behind us and the markets have remained at this level. And sentiment has remained very, very poor, and markets move on sentiment. This is the reason why we are not going back to 21,000, which people were trying to hope for. In fact, the setup is that you're going to explode on the upside because you have multiple reasons. One, the earnings have reversed. Two, the government has given first tax cuts, now GST cuts. 3, the interest rate cycle is towards the downside, even though it may be taking time. And all of this put together, now you're getting closer and closer to next year's budget. As you hit January, you will hear more spending plans from the government. Now you put this entire picture together in front of you, what you're looking at is a period where you get earnings revival, PE re-ratings, and growth coming back. And that's why markets are going to do well. The trade deal will just be the icing on the cake. So this is how markets are set up, and that is why when you look at individual stocks, even over the last 5 months, many have hit 52-week highs. Individual sectors like banking, which was one of the most undervalued sectors of the year, has now gotten attention and started to take off. So you're seeing many of the financials actually do very well. In fact, the second line financials, whether you consider it in PSU banks or even private banks which are not front line, are outperforming the big private banks. So there's a lot of interest happening in the financial space because valuations dropped over a period of time, even though there was growth. And now if the credit cycle turns around, part of which is slightly visible, then the financial sector is going to do exceedingly well. So that is one sector that you have to focus on from a pure value perspective. And we do have a couple of value wave investment ideas over there as well. So this is the beauty of the market, that rotation is one thing that we have gotten used to over the last several years, but there are segments which are doing particularly well. Stocks are individually outperforming the indices. Metals index also ended up very, very close to previous highs and is surpassing it, and that's what you're seeing in the metal stocks as well. They are also outperforming the index. You're seeing that in autos, you're seeing that in various pockets of the market. Some places which had deep correction, so they've not gone back to an all-time high, and some places where the correction was not so deep, many mid caps and small caps have gone back to all-time highs. So you really need to focus on stocks as far as investing is concerned. I know Nifty is the pain point when it comes to Nifty traders, but that's just something that we'll have to live with. That okay, Nifty is not behaving the way we want it to, even though stocks are going up, Nifty is stuck here because the breadth is not strong. There are segments like the IT sector which make a significant weightage in the Nifty that are not doing so well. There are also the PSU stocks which in general, apart from maybe a few here and there, that are not doing outstandingly well. They are still in a consolidation and corrective phase. So they are not adding those brownie points that we were seeing in 2023. But we are seeing a comeback in the oil and gas space. Apparently stocks like Reliance are starting to contribute to the index move, which they were not doing last year. So it's a very, interesting setup. You really need to focus on where the action is. Like when I said oil and gas, I mentioned Reliance, but did I mention oil marketing companies? They've been on a rage of their own. Again, they are a bunch of PSU names. So PSU banks, OMCs, many of the PSU names are doing well. But there are others in the whole basket that did well last year that are still correcting and consolidating, and which is why you're not feeling this broad-based move if you ended up with the stocks that are not in momentum. So again, that requires some amount of research to focus on where the momentum really is. So that's what we want you to do. Another big worry point with a lot of people is global markets, right? US markets. But let me tell you, just go back 1 year when India was actually correcting from September onwards. US market was holding out against us. In fact, I think India and US have been diverging for a long, long period of time. And when that divergence happened last year, we saw the first signs of outperformance of Europe and emerging markets over the US. And then after that, of course, post the trade announcements, we have seen a reversal in that, and then US did outstandingly well over the other markets. But again, we are now in the same seasonal phase where the US market has run up too much. It is losing momentum. So you're seeing volatility again and again. You see these 400, 500 point drops in the Dow. You see a big correction in 5-6% correction in S&P. Then again it recovers to a new high. Again you're seeing a big correction this week. Weekly momentum is in sell. This is the same thing that was happening a year back. The end game was that other markets outperform the US. I think something similar is going to happen between now and March, that you're going to see outperformance of emerging markets. I think this time it's going to be India. Last year, India was on the way down, even when US was holding out. So India didn't really play a role in that outperformance cycle last year. This year, I think the time has come that we are going to see the outperformance of the Indian market over and above the other markets, and that is, I think, the big play over here that India is set up to take off. And can other markets also play there? Yes, because if you look at the ratio, again there's another ratio chart. We've discussed it in the weekend with Indiacharts, our weekly show that we do in the India Insiders Club, discussing entire market setups across the world and what it really means for India in the end of the day, which is what matters to us. This is the ratio chart of the EEM or the MSCI Emerging Market Index with the S&P. And this has been breaking out of an inverted head and shoulders pattern. It's a beautiful HNS, one classic one that you get in textbooks only. So good for future textbook publication. And now that it is broken out, it's already given a signal that emerging markets are going to outperform the US. And like I'm saying, I think India this time is going to play a lead in that action. Now, part of that lead will come because of the interest rate cycle. The only surprise in that interest rate cycle's story for me right now is that the dollar is still not falling. Now, of course, the dollar got very oversold, and therefore we did see a bounce in the dollar over the last couple of months. To me, it almost looked complete, but last few days we've seen the DXY bounce pretty sharply, mainly because the Japanese yen is weakening. That's a major component of the DXY. But otherwise, I would have thought that the DXY time has come for it to roll over. And as we head into January, as we get closer and closer to Powell's exit from the Federal Reserve and a new Fed governor coming in, who's going to be someone that Donald Trump is going to try and appoint, who's going to be a dove, who's going to cut interest rates. That's the whole plan that they have. So you'll eventually have somebody who toes the line of the government. And if you're going to get those rate cuts, eventually it's got to mean a weaker dollar, and it can mean a pretty strong commodities market, a commodity cycle. So we have so many things now kicking in, one after the other. But the reason I highlighted that is the interest rate cycle, I think, is one of the things that is going to be positive, going to be one of the saviors, and going to be one of the turning points for the EM space. And we're just waiting for some more confirmation of that. Broadly, we know the theme. We've heard it from what the policy makers want to do, and that's sort of given us the direction. We are just not seeing it in markets yet, and that is why I think confidence is missing. People still feel that no, this is a bubble, it's going to blow up, there's going to be a recession. Still we are not getting recessionary data. There's an inverted yield curve, and still that is not playing out. So all of that is in the backdrop of government action. Remember that governments are the biggest movers of markets, and therefore you cannot not pay attention to what government policy is. If you end up making a plan against policy, you will end up being in the wrong place. End up having a wrong view, and then you end up sounding like a conspiracy theorist, and that's not what you want to be. You want to participate in the markets because we want to make money, and to do that we need to pay attention to which side the policy action is really moving in, and set ourselves up to take full advantage of that. And like I said, as far as India is concerned, the entire policy action is for takeoff. It's only a matter of time. The curve has already started to happen, which we are seeing in this quarter's results. And I think it's not going to stop here. The curve is only going to accelerate to the upside. I won't be surprised, and this is such a tough call to make, and I'm making it publicly. I won't be surprised if the next wave that is coming is going to be even more powerful than what we have seen over the last couple of years. You will forget the bull market that you saw from COVID to now. You will actually see something completely new that will emerge as far as specifically India is concerned. And that is my sense, because these negative emotions and sentiment is so high that it can only explode on the upside. Lastly, I'll leave you with this final data point, and that is the strongest force here for Indians is the domestic institutional investors. They've been holding on to their long position that they've managed to create in the index futures market. This is the participant wide positioning that we get, and you can see the entire data on the Strike Money platform that we've created for you. You can scan through the data, look at the history, and when you see the last year of data, you see that they're just consistently staying there. They're not cutting it. Historically, whenever the markets would go up, they would reduce their long positions. This time around, after the correction that we saw in July, they've just added their longs back and are just sitting there, not cutting anything. That shows you the confidence of the smart money, the institutional investors, domestic institutions that are behind, standing behind this market. And that's another reason why it's not going to fall. And when the momentum picks up, everybody's going to be chasing stocks to the upside. So the only question is, how soon are you going to be on that bogey train, or are you going to wait for everybody else to be there before you, get back in? So take full advantage of what is coming. It's going to be big. And check out the Indiacharts research services that are going live, and also take full advantage of that, because that's years of work decades of work that we've put together these models that I believe can be extremely accurate in giving you the right inputs to creating wealth, right? So that's what you really need to get down to doing. And this is the best time to do it, a bull market, right? That what more could you ask for? So go ahead and check those out. And if you're somebody who does his own research, check out Strike Money, which is for people who are involved in doing their own research, their own analysis, and coming up with their own ideas. It is fully equipped to do that, and we are always engaging with everyone on the platform to make it better and better every day. Thank you.